No matter how much Donald Trump enjoys steering intrigue over tariffs, he will not keep markets in the dark for long. Previously, he set February 1st as the date for the introduction of higher tariffs against multiple US trading partners. If the US president wants to position himself as a tough leader, he must act accordingly, meaning he needs to back up his statements with concrete actions. Yesterday, he once again threatened to impose 25% tariffs of imports from Canada and Mexico. As for China, the only certainty is that tariffs are coming, but the timing and specifics remain unclear. However, Trump's repeated mention of 100% tariffs against the BRICS nations seems completely unnecessary, given that BRICS countries have no immediate plans to replace the US dollar as a reserve currency. Why does the US president keep issuing dramatic warnings? Only Trump himself knows the answer. Meanwhile, the prospect of a trade war between the United States, Canada, Mexico, and China continues to support the rise of the US dollar. Its index has been gaining ground for the fourth session straight. Today, the US dollar index is trading above 108 points, steadily advancing toward a weekly gain against most of its major counterparts. At the same time, the economic outlook in the US is becoming obscure. The new US president inherited a strong economy. For example, consumer spending surged by 4.2%. The highest figure since the first quarter of 2023. The US GDP data for the fourth quarter of 2024 released yesterday also showed solid performance, while forecasts had expected a higher figure of around 2.7%. The actual growth of 2.3% may already been an ultimate peak under the Trump's presidency. A decline in economic growth could happen as early as the first quarter of 2025. Analysts foresee 2% or even lower as a possible starting point for this slowdown. And yet, it has only been 2 weeks since Trump's inauguration. This means that the strength of the US dollar in the long run is far from guaranteed. Unlike how it seemed in early January, the interest rate differential between the Fed Reserve and the European Central Bank alone may not be enough to push the euro to parity with the dollar. Even though the Eurozone economy has unexpectedly stalled, dragging GDP growth down to zero, the euro is still trading higher. The single currency could have stayed afloat thanks to a statement from Christine Lagarde. According to reliable sources, the ECB president is set to introduce changes to the accompanying statement at the next policy meeting. The phrase stating that interest rates are restricting economic growth is expected to be removed. It means that further rate cuts may not be as aggressive as the market expects. The signal has hawkish, which helped the euro recover from a more than a 1-week low on a Friday. The single currency even managed to hold gains within the range of 1.0371 to 1.0414 for some time in the first half of the day. However, Eurozone inflation reports reignited selling pressure on the euro, pushing the euro-dollar pair below the critical level of 1.04. As a result, the resistance level of 1.0415 remained a firm obstacle for the bulls. As long as the euro-dollar pair stays below this level, traders are better off sticking to a bearish strategy. At the same time, the scenario of US tariffs against the Eurozone remains on the table. If imposed, the Eurozone's GDP could slide from a zero into negative territory, forcing the European Central Bank to accelerate rate cuts. Oil prices reversed upward on a Friday after the weaker-than-expected GDP data from the United States and the Eurozone, which pointed to lower demand. Trump's renewed tariff threats had the opposite effect on the market. For example, Canada supplies around 4 million barrels of oil per day to the United States, and tariff-related obstacles could even halt this flow. As the February 1st approaches, the risk of oil supply disruptions in the United States and other regions is becoming more realistic. This means that the commodity market will likely depend on the US policy in the near term. For now, Brent crude is trading within a narrow range of $75 to $77 per barrel and is on a track for its second consecutive monthly gain. The Russian ruble continues to appreciate moderately, but its growth is driven more by the absence of news rather than by any positive developments. And this is particularly notable given that most news on the ruble tends to be negative. A period of a calm in currency trading has also been supported by the extended Lunar New Year holidays in China, which will last until February 3. Besides, the ruble's rally can be attributed to decent trading volumes on the exchange, indicating a temporary surplus of a foreign currency supply. However, experts believe that this trend is more due to the seasonal factors limiting demand rather than the ruble's inherent strength. And thus, if today's information background remains unchanged, the ruble may see further moderate gains. So that's all for today. We continue to follow developments in the financial markets. Subscribe to our channel and follow news with us. We wish you have a nice weekend and see you soon.